Welcome to Basic Accounting. Financial accounting has subcomponents we call bookkeeping. So what you're learning basically is the principles of bookkeeping for beginners, then accounts, then the complex stuff that will come later on. So at least I want you to understand what the definition of accounting is, the types of organizations, the elements that are involved in accounting, the accounting equation. Then we go to the trial balance. But before we touch the trial balance, we touch the ledger accounts and we look at the principles of double entry bookkeeping. Then we answer some quiz questions in that order. So accounting is defined as a process of classifying, a process of analyzing, classifying, recording, and summarizing, communicating and interpreting business transactions and events that are expressed in terms of money. So we use monetary form. And bookkeeping is simply a systematic way of maintaining accurate and complete records in financial accounting on a daily basis. That's the difference. So what is a business transaction? When we're dealing with any business transaction, we're simply talking about an event that is expressed in monetary form. This is an event that is able to be recorded in the books of accounts. So in accounts, we'll be using terms like buying goods. To buy goods is to purchase. So there's a grammar that we need to now acquaint ourselves with. If we're selling goods, it's a sell. Okay, paying wages, paying rent. So we're going to talk about these events of activities and explain them in the most basic manner. Any questions so far?
No.
So there are different types of
Collins,
yes.
just a humble request. If it's okay, if you can forward me the video after
Sure.
class, because I'm working. So
I'll send. Okay, so the basic organizations that we have what we call a sole trader, a partnership, a company, and a cooperative. So when we're talking about a sole trader, we're looking at a one-man business. It is owned by one person who's in charge in the daily activities of the business. He's the one who makes the managerial decisions. If the business succeeds, he enjoys all the profit. If the business fails, he suffers the loss. So the sole trader can be a grocery shop, a shoe repair, a workshop. He may have a few employees if he decides to. Okay, he has advantages and disadvantages. Okay. So can you tell me the advantages and disadvantages of sole trader from what I've just explained so far?
I don't like that's what anybody
Are you talking? I'm talking about the advantages and disadvantages of what? A sole trader.
So the advantages of a sole trader is when they enjoy all profits to their full extent, then they also suffer the loss fully when there's a loss in the business.
Okay, great. Yeah. Then we go to a partnership. This is a type of a business which is owned by two or more people. These individuals are called partners. They put their resources together and can have a written or oral contract, which is called a partnership deed. This partnership deed will lay down how much each partner must contribute, how the profits will be shared, how many hours each partner must commit. Okay, so a partnership has its own risk. So they share all the risk, they share the profits. They share the liability, and we have what we call unlimited liability, meaning it goes to the very extent of the owner's own personal belongings. Then we go to a company which is created by law. In Zambia, we use CAP 3.
Sorry, Ken, can you just repeat what you just from saying on partnership, where you explained the veil being lifted?
So I was saying partnership has what is called unlimited liability. This means that their liabilities in Congole, they make because of the bad decisions can go to the very extent of their personal belongings. So their veil is lifted in the sense that even their own household goods can be taken to pay the liability. The liability is the amount owed. And this also applies to a partnership. They also have what we call unlimited liability. So for company, we have the laws of the land. In Zambia, Cap 388 incorporates a company into a person. This person will have powers to sue and be sued, to sell property and own property, to make contracts and borrow. In court, the person who owns this is called a shareholder. The shareholder can be sued by the very company he owns. Now, shareholders will contribute their initial capital. This will help the company start up. These shareholders are elected to what we call the board of directors, who represent the interests of the company and the shareholders. There are two types of companies, a private limited and public limited company. The shareholders are two types. We have preference shareholders and ordinary shareholders. The preference shareholders are paid first. Then last are the ordinary shareholders, who receive the residue after the shares have been paid out. The advantage of the ordinary shareholder is that they have voting rights, then they have a say in the company. The preference shareholders are like speculative investors who are just interested in having a fixed return. No wonder they are given a fixed dividend. The cooperative is simply a form of business which is owned by its customers for the purpose of what? Providing a common service to its members at a low cost. These ones make profits, of course, which are distributed in proportions to the members. So the difference between these other ones, that these ones, the customers themselves are the ones who give market to themselves. All right, the marketeers, for instance, in Kamba Cooperative, when they buy stuff, they buy from themselves. The profits are shared amongst themselves. A quick, can you remember? Bookkeeping is a subset of accounting. True or false? It is true.
Yeah.
An accountant is only interested in analyzing business transactions. No, that's false. A trader is owned by one person.
True.
True. A cooperative is a form of business whose sole aim is to make a profit. False.
False.
A business entity can be separate from its owner. True. Okay. So we have elements that we use in accounting. We have what we call assets. We have what we call liabilities. We also have what we call equity. These ones form up an equation which we call the accounting equation. The assets must be equal to the capital plus the liabilities. When we take this on the other sides, assets minus what? Capital is equal to the liabilities. For one, we can take this one. Assets minus liabilities is equal to what? Capital. It's the same thing. We're just using operations of mathematics. Now, what are assets? Assets.
Just a minute there, sir.
Yes, please.
Yeah, on the calculations, those formulas are coming up. Yeah, kind of just go through once again. I was behind.
So this is what we call the accounting equation. It is given by assets is equal to the capital plus the liability. This is what we call an accounting equation. So what are assets? Assets are things that the business owns or uses to generate what? Cash. Capital is simply the money that a company, an organization starts with. Liability are simply the borrowed money. So collectively, when we add these two, they make up our assets. From the assets, when you subtract the capital, what remains is the liabilities. From the assets, when you subtract our liabilities, what we remain with is the capital. So this is what we call the accounting equation. So there are two types of assets that you need to know. They are what we call current assets. These are assets that are easily converted into cash within a short period of time. They are arranged in order of liquidity. The most liquid asset is cash. Then we go to the bank, and we go to the what? To the debtors. The debtors are also called account receivable. A debtor is a person who owes us money. And we go to the prepayments, and we pay in advance. And we go to the what? Inventory, which is called stock. So these are called our current assets. Stock is also called inventory. Okay.
So on the current asset, what about like stationery? Where does it fall?
So stationery is not an asset, it is an expense. So you need to distinguish between what we call capital expenditure and revenue expenditure. I'll come to that later on. But just to explain, because you've asked, capital expenditure are things that we buy for use in the business and not for sale. Okay, they are meant for permanence, but there are small expenses for running costs like stationery, like repairs on machinery. Those are called revenue expenditure. If you buy a pencil, it's just for stationery. It's not an asset. No. It's stationery. It's a revenue expenditure. If you pay for water bills, they are to facilitate your ability to work. Is that clear?
Yeah, I thought maybe I was just thinking. I thought maybe, for example, a stationery, you have got those. Maybe, for example, someone his or her business is in stationery. Then an event want to convert those stuff or items into cash. Can you consider that one also as an asset to say, okay, my business is in?
That's a very good question. So if you are selling cars, that is your what? That is inventory if they're for sale. But if you have a car that is in a business for use, it's an asset. So if you're selling printers, those printers are for resale. They're under stock. Those are assets. But if you're using printers for use, that is an asset for use. So there's a difference. I'm saying capital expenditure are meant for use. All right. Have you seen the difference? Stock is meant for resale. Are we together?
Yes. So stationery can be categorized as what now, in a nutshell?
Now you're confusing the term. Stationery is an ambiguous term. So we can buy stationery like plain papers, stationery like pens. Those are expenses we use for running the business. Okay. But if you're going to talk about stationery that is meant for resale, like the printers, okay, like the plain papers, they go into this category of stock. But if those stationery that we have, like the printers, the computers, if they're meant for use in the business, they fall under fittings and fixtures. They are under fixed assets, therefore use in the business. So they will change form depending on how you use them. Am I clear to the rest of you?
Yes, it's very clear.
Yes, it's very clear. Yes, it's clear.
Okay, so the fixed assets simply are assets used in the normal operation of a business to produce, to sell goods or perform services for its clients. Examples of fixed assets are buildings, equipment, land, vehicles. The other term for fixed assets is called the non-current assets. We go to what are called intangible assets. These are assets that will provide benefits to the business for many years, but have no physical substance. We can't touch them, they're invisible, like goodwill, like a patent, like a trade name. These are all intangible assets. For instance, Total, if you're going to trade under that name because they have a trade name, you don't have, they have a goodwill, they've made a name, that is categorized under what we call our intangible assets.
Excuse me, Mr. Collins.
Yes, sir.
So what are debentures and the bonds, and they fall under what?
So we'll come to debentures as I'm explaining the liabilities here.
Okay, all right.
So liabilities are simply debts that a business owes its creditors. So a person that we owe is called a creditor. The person that owes us is called a debtor. So liabilities are simply the debts that a business owes for goods and services. You must understand that most businesses engage in trade that is on credit basis. Now, if a business borrows money, it becomes a debtor to that person, and the person or the business to whom it owes is called a creditor. So if a business fails to pay, it means a debt when they are due, we call them liabilities. Now, liabilities come in two forms. We also have what we call current liabilities, and we also have what we call non-current liabilities. So current liabilities are simply liabilities that are due within a short period of time. For instance, wages that you haven't paid, salaries owing, you're supposed to pay electricity, you have not paid. All these are what? Current liabilities. So we also have long-term liabilities that will take a period of time to be paid. We have bonds, we have debentures, we have bank loans that are huge. Now, a debenture is simply a long-term, it's a loan which we buy, which is secured. All right. A debenture is a long-term loan. Now, debentures have their own features that you can talk about in depth, but we can simply say it's a type of a bond or a debt instrument which is not secured by collateral. Now, since debentures have no collateral, they usually rely on the creditworthiness or the reputation that the company may have. So corporations will engage in borrowing money without using any surety. And these ones are huge sums of money, which we now call debentures. They are not secured by collateral. They are long-term loans, which government or corporations can use to borrow funds from the public. For instance, if the Republic of Zambia wants to raise money to construct the road from Lusaka to Ndola, they can issue a debenture. They'll get money from the public, and without any collateral, tell them, so we're going to pay you within this period of time. So it's a long-term loan. We also have what we call bonds, although I'll teach you this in your second level under corporate finance. When we're dealing with a bond, we're looking at securities that are issued by government or companies when they want to raise money. So when you're buying a bond, you're actually giving the issuer a loan. So if I'm buying a bond, I'm actually giving you money. If I'm issuing a bond, I'm borrowing money. So we may agree to say I'll pay the face value at a specific date with some periodic interest. So I'll be paying you interest in between, but your amount that you're giving me, I'll give you after 10 years. Those are called bonds. Are we together? Is that clear?
I'm a
Yeah.
little behind on debentures when you talked about when you put them in a category of non-current liabilities. So you're saying every non-current liability is a liability that does not need
Any-
collateral.
No, any non-current liability is a liability that takes more than 5 years to pay back. More than 1 year to pay back.
Okay.
These are, if the Congole, the loan takes more than 1 year to pay back, it's called a non-current liability. But we have examples of non-current liabilities, like I have explained. So I've talked about a bond. A bond is simply a secured security that government or corporations use to borrow money. Okay, but what
So
best?
even with sorry, so you mean debentures are an example of a non-current liability?
Yes.
Okay.
Yeah, they're just example because you can't pay a debenture within it's a lot of money. It's a long-term loan. Except that a debenture, it doesn't require collateral. Okay. For loans, you need collateral. We're getting from banks. A debenture will use its good name, its goodwill. All right. So owner's equity, on the other hand, whenever you hear started a business, it means that the business has no money of its own. So when the person puts his money, it's like the business is borrowing from the owner. Remember, these are two different entities. So that is what we call owner's equity. It belongs to the owner. We have what we call partnership equity if we're dealing with a partnership, shareholders equity if we're dealing with a company. All right. So equity or capital is the money that we start. So owner's equity will usually increase when the money is invested in a business through revenue generated through a sale of goods and services. So it decreases when the owner takes away from the business for personal use. So whenever a business is using money for personal use, we are reducing our capital. This is called a drawing. So we use pairs to account for accounts. So we have debit side and the credit side. So purchases increase when we debit them. Expenses increase when we debit them. Assets increase when we debit them. So to reduce assets, credit. To reduce expenses, we credit. To reduce our purchases, we credit. So the revenues, like capital, to increase them, we credit. Liabilities, to increase them, we credit. Sales, to increase it, we credit. The opposite, to reduce them. So revenues, we debit to reduce them. Liabilities, we debit to reduce them. And sales, we debit to reduce it. So we use the term pairs to simplify our language. So if we want to decrease the owner's equity, we're going to do drawings. That's why drawings will come here. The drawings will reduce our revenues. Okay, so let's do a quick, can you remember which ones are assets, liabilities, and equity? So money in the bank is called what?
Asset,
Asset.
current asset.
The current asset to be specific, excellent. Money from a business owner is called what?
Equity.
Owner's equity to be specific. Furniture in a business is called what?
Current assets.
Excellent, current asset. Money owed to creditors is called what?
Debtors.
It's a liability. A loan from a bank is called what?
Oh,
The liability.
It's also a liability. And the trade name is an example of what?
debentures.
Try again. An intangible.
Intangible assets.
Excellent. Who's that? Yes.
Tawela.
Great. Okay, so we now go to the accounting equation. I already explained how the accounting equation comes about. Assets.
Sorry, I'm kindly asking if you can go a little bit back so that I can screenshot that. Or maybe you make available,
Yes, a video.
you
Yeah,
make this video available to the group.
sure.
Thanks.
All right, so we now need to go down to understand a few issues regarding categorization of the balance sheet. A balance sheet is a book of accounts that shows what a business owns. So a balance sheet consists of current assets, fixed assets, investments, intangible assets, current liabilities, long-term liabilities, owner's equity, and retained profits. So what are the examples of current assets?
No, but cash in the bank,
Inventory.
Cash, bank.
Cash. Bank.
Give me the order. Debt
That's debtors.
and
Payments
stock.
and inventory.
Yes, inventory, correct. Fixed assets, examples, buildings,
Loan.
land, motor vehicles, fittings and fixtures, all these are assets. Intangible assets, give me any three.
Trade name.
Trade name,
goodwill.
goodwill, and a patent. All right. So investments could include bonds, stocks, and shares from other companies for more than 1 year. Liabilities are claims of the business.
Sorry, just a minute. On intangible assets, where we said trade name, goodwill are examples, and what's the P?
The patents. A patent.
Patents.
Yes, a patent right. For instance, if you're going to trade under a certain company, you need to have a patent. You need to have, yeah, the patent.
So the other one you said you said we give you in order. There's
These are
formula
have
to
no
use.
particular order. There's no order. These are just fixed assets. There's no other buildings.
On the
vehicle.
current assets.
Yes, even these there's no order. Just here we use this order of liquidity. So long-term loans or liabilities are simply liabilities which are more than a year. Examples are loans, mortgages, bonds, debentures. Owner's equity, it is simply the amount which the owner puts into the business. So balance sheet has two types. We have what we call the account form. We also have what we call our financial form. Okay. So these are the two forms that we use when we're dealing with a balance sheet. Okay. So now let's delve into the forms. So the account form simply reports the assets on the right side, the liabilities on the left side. Then we have the financial form, which looks like this. It's a common form that is used when you're dealing with the vertical analysis of our balance sheet. I'll discuss this at length when I start looking at these books. So we've learned that bookkeeping is a subset of accounting. The types of businesses we've talked about are sole trader, partnership, companies, and cooperatives. The three fundamental elements of accounting are assets, liabilities, and equity. I've also looked at how we display the assets in the balance sheet. and that assets, liabilities, and owner's equity make up what we call the accounting equation. And the two forms of balance sheet we have the vertical and also the account form. So if we're using the balance sheet we're using this form to balance up assets is equal to liabilities plus equity. So what is missing here? 5,000 is to master. Then to get this one, we simply subtract this one from there to get the balance. To get here, we just add this one and that one, we get the answer there. We're just appreciating the principle. So state whether it's an asset, liability, or equity. Savings in the bank.
It is current assets.
Current asset, correct. Money or to a lender.
Liability.
Liability. How about owner invested 5,000 in the business? What do you call that?
That is equity.
Capital.
Capital. Is it capital equity?
The same thing, owner's equity, which is capital, correct.
Okay.
Then rent paid in advance to the landlord.
Prepayment or advance.
Prepayment.
Hello?
Yes.
It's
Prepayment.
prepayment or advance, isn't it?
Yes, it's a prepayment, which is an asset. A prepayment is an asset as well, a current asset. A piece of land.
Asset.
Asset.
It's a fixed asset to be specific, all right? So let's match these letters using the numbers. So for instance, owned by shareholders, it is 3, which is a company. More interested in providing services at a low cost rather than making a profit. Which one is it?
The first one, is it answered?
Yes, answer this one. So,
Cooperative.
cooperative, good, it's interested. Then owners share risk, liability, and management of the business.
Partnership.
Partnership.
Then is owned by one person.
Sole trader.
Sole trader.
So, all right. Let's go to unit 2. We're going to talk about the principles and concepts of accounting. So principles, we have about 12 principles. I'll discuss 11 in here. We have what we call the entity assumption, the going concern, the periodicity, monetary concept, the historical costs, objectivity, principle, the revenue realization, the matching concept or across concept. We have what we call the consistency, disclosure, and prudence. These are concepts you need to know. The entity or separate entity principle simply assumes that the owners of the business are different from the business itself, meaning the personal affairs must not mingle with the business. So this means that if you have a business, you should not abuse the business property. Just because you are a major shareholder, you use the car at the farm, the company can sue you because it is a separate entity. Going concern assumes that you must look at a business to existing forever, to having a going concern. So if you're evaluating a business, you must not value it as if it is what going to die tomorrow. The people who started businesses, but we're looking at it going on for the future. So it must have a going concern. Periodicity simply assumes that the result of its operations must also have a standard time period where you should be reporting either after every day, a week, a month, or half a year, or every year. So it simply assumes that there should be a period as at which you are going to give a financial statement. The monetary principle simply assumes that all transactions must be in monetary form. The historical cost simply assumes that our current liability and assets must be costed at the point or cost at which you bought them. If you bought land in 1990, that's a cost value. All right. Even if it was assumed at 100,000, the historical cost concept simply says that you must value assets at their original cost until it is sold or written off. It doesn't mean that you necessarily need to set it at that amount, but that is the value that you're going to value it at. So we've talked about 5, we're remaining with 6. Can you remember on this 5? So give me the numbers coinciding with these ones. A company's balance sheet should report its land at the price they paid to acquire it. What principle is that?
Historical.
Historical. Company accounts should cover a specific period of time. Periodicity. Personal assets should not appear in the balance sheet.
Entity.
Entity.
Business will remain in operation for a foreseeable future.
Going concern.
Going concern. 2.
Transactions must be recorded in currency.
Monetary unit.
Monetary. Excellent. All right, so we now go to objectivity principle, which requires all financial transactions in a company should be independent of error and bias. They should be what? Verifiable to make it reliable. The revenue realization principle simply says that the price paid for the goods is called revenue. Sales are a revenue. So I call them sales revenue. So this principle means that revenue is realized and recorded when goods are sold or services are rendered, and not when cash is actually received. So when you make a sale, even if you haven't received cash, that sale must be recorded. This is called revenue realization principle. The matching principle simply says that costs must match the revenue and in the same period. It is also called the accruals concept. If you make a prepayment, you haven't enjoyed the electricity for next year. You're being clever to reducing your profits so that you pay less tax. Accountants have noticed that. So you only charge the expenses for that particular year. Consistency principle simply assumes that you must adopt one accounting practice. There are a lot of accounting practices that are there, but for your consistency, you must adopt one that must throughout be an epitome of your accounting format. Disclosure principle means that you must provide all relevant facts of information, accompanying notes if possible for a layman to understand the information to make informed decisions. For instance, we have potential investors for a business, so you decide to hide some information and they want to purchase some shares. So disclosure principle simply states that you must avail all the important data that is needed to make informed decisions. And finally, prudence principle simply means that there should be carefulness or good judgment when you want to report financial information. So when there's a situation where there are two acceptable alternatives for reporting, it's better that you choose an alternative that will result in less net income or less asset account. This principle also makes sure that you don't overstate your assets, you don't overstate your income, or you don't understate your liabilities, or you understate your expenses. So this is a principle which we call the prudence principle. So what have we learned? The entity assumption, the owner of the business, and the business are two separate entities. Going concern, the business must operate in the foreseeable future. Periodicity principle, report financial results with a designated period of time. Monetary principle, expressed in currency. Historical principle, assume price in the balance sheet to be based on its original, not its current value. Objectivity simply assumes that accounting statements should not be based on, they should be based on verifiable data. Auditable. Revenue realization simply says that revenue should be recognized soon as it is earned. Matching is also called the accruals concept. Expenses should be recorded in the period which they are incurred. Consistency simply says we need to adopt one standard or method of reporting throughout the year. Disclosure, produce all necessary information. Prudence, don't overstate your assets and income, don't understate your liabilities and expenses. Show it as it is that people may understand. So which principle are we using here? All transactions of a business should be recorded. Brian Bell started a business, however, his business is around even now. Accounts must be reported every year. Personal affairs must mingle with the business. This is entity concept. Revenue must be earned and must agree with the cost incurred. Realization.
Revenue recognition.
Yes. All right. Let's see if we could go to the quiz that we had today. This is for the undergraduates. The drawings include the capital account. It's false because capital is on the what? On the credit using payrolls. So payrolls. So to increase capital, we credit, meaning to decrease capital, we debit. So here to increase capital, drawings increase capital. No, they reduce it. I actually mentioned it. Okay. Stationery is an example of what? An expense. All right. Drawings is what? Capital account. Yes, affects capital.
Drawings, not assets.
Drawings is a what?
I thought it's an asset.
No, it's not an asset. When you draw, what are drawings? When you
The
remove
money,
for
the
personal.
money gotten business for the person.
Yeah.
Yeah, my brother, utakuwa versa zianzi.
All right. So we go to inventory. Inventory is what? Current asset. Stock.
That's it.
Equipment is an example of what?
Asset.
What kind of asset? And
Fixed asset.
is a fixed asset. Good. So to decrease an asset, what we do? Assets are increased where? On the debit side.
Debit.
So to decrease them, we do what? We credit. Right?
Credit.
Right. So we credit. Every debit entry should have a corresponding credit entry. That is what we call bookkeeping. Sales is an example of what? A revenue. It's got sales revenue. So which one of the following is revenue expenditure? Expenditure on heating and lighting. It's revenue. Okay.
How?
Yeah, I'm also confused. How?
I said revenue expenditure is simply for facilitating the usage of, it's an operational cost. Repairs on fittings, those are revenue expenditure. They're found in the income statement. Heating and lighting, those are revenue expenditure. Salaries, yes, they're for sustaining in you. So when you are in home, you need to understand what your revenue expenditures are. Panga and revenue expenditure, yes, sir. Light, water bills, just to maintain it. But fixed
So
assets,
heating and lighting is chimochi and nama lighting.
Heating and lighting factories.
So okay.
Yes, but if you buy a fridge,
Thank you, Anda.
if you buy a stove, those are capital expenditure. They're meant for use in a house. That is capital expenditure. They're meant to stay. Revenue, they're meant for utilities, for sustaining you. Okay. Are we together? So buying a non-current asset is no, because this is a fixed asset. It's meant for use. Expanding an existing property, no. Raising additional capital, no. So revenue expenditure is this. So goods on credit will initially be recorded in what we call a purchases journal. So
Purchases.
it's a day book, purchases day book. How about goods sold on credit are written in a what? Sales day book. A day book is
Sales.
simply a book where all credit transactions are recorded. These sales books are called journals. So journal is a term which we use as a day book. So if somebody returns goods to us after we sold them, we call them sales returns. If us, we bought and we are returning, it's called purchases returns. That's when it goes to this, what we call our purchases returns day book.
On B, you said, what do you say on B? Sales day book.
The sales day book is where we record all goods bought on credit. All right. All goods
Oh,
bought
okay.
on credit. All goods bought on credit are recorded in this in the what? The purchases day book. So we have a number of books in accounts that you need to know. So all credit books, all transactions on credit are recorded in a book called what? A journal. We have 5 types of journals. Number 1, we have a sales journal and sales returns journal. We have a purchases journal and purchases returns journal. And we have what we call the general proper. Okay? Or the general journal in short. So what document is produced when
Sorry, just a minute before we move on. You said 5 types of journals. We have the sales day book.
and the sales returns table?
Sales and return sales book.
So the sales day book and the what? Sales returns day book. A day book is called a journal. So we can use day book in form of journals.
Journal.
Okay. We have
Then the second one.
purchases journal and purchases returns.
Mhm.
And finally, we have what we call the journal proper, or the general journal, if you like. So what we write in the sales day book, goods sold on credit. What do we produce when we sell goods on credit? And
So, Mr. Collins, so you're saying like this one, goods bought on credit. It's not did.
the answer is D.
Okay.
I'm just explaining what these ones. The answer is D. Trying to dominate. So all credit transactions are recorded in a day book. All cash transactions are recorded in a cash book. A cash book is a book of first entry where all cash transactions are recorded. The document that is produced for a cash transaction is called a receipt. A receipt is produced when you pay for goods on cash. Invoice is used for.
So if I understand this correctly, Mr. Collins, these the ones written day book, these are only on credit basis.
Yes, only on credit.
Like purchases.
Yes.
Oh, okay. So and then if it's a cash transaction, then it's a receipt.
Yes, we transfer it in the cash book.
The receipt book.
Yes, in the receipt book, yes.
Okay. Understood.
All right. So if a customer bought goods from us and they returned them because they were damaged, wrongly sent, expired, broken, when they bring them back to us, we call them sales returns, and they call into a book called the sales returns journal. Sales
I'm
returns.
so sorry to take you back. So you said all cash transactions are recorded in a cash book, and where are the receipts sitting when they are sold?
When the receipts go into a cash book, all receipts. Let me talk. I think you listen to the recording later on because I'll just expand on it. I'll send you the notes. So what I was saying is, Pam Congole, the books that we use, we call them books of prime entry. These books of prime entry are called journals. Then we have transactions for all sales made on credit. They go into the sales journal. Then transactions for goods that are brought back to us after we sold them, they go into a sales returns journal. Then the document we produce for goods that are returned to us because they are damaged is called a credit note. We go to the purchases. All credit purchases are recorded in the purchases journal. But when we buy, also we find that if they are wrongly consigned, damaged, expired, we also record in what is called the purchases returns journal. Purchases returns journal is also called returns outwards because we're taking it out of the business. Sales returns journal is also called returns inwards because they're coming into the business. What document is produced for sales returns, the sales returns journal? It's called a credit note. What we use for the purchases returns, the document we produce is called a debit note. What document we produce for cash transactions? We call it a receipt. What document do we use when we want to deposit money into the bank? We call it a deposit slip. Who do we call a person who owes us money? A debtor. The other term for a debtor is account receivable. A person we owe money is called a creditor. The other name we use is account payable. So these are key books that you need to know whenever you're transferring goods from one point to another. A document produced is called a delivery note. Those who work in government, we have seen good received note, delivery notes, as evidence that the goods that have been transferred are being received or delivered. All right. So this is how you're supposed to answer this as BIDs. So which one is an example of an element within equity? The reserves or equity. This is now for the postgraduates. Your quiz 2. I don't know that quiz 2. It's about the concepts. Okay, let me go to quiz 3. An example of an equity account is what? Accumulated reserves. To increase depreciation, you debit it. No, depreciation is an expense. So all expenses we debit to increase them. But accumulated depreciation, we credit it. The process of making entries in the books of an account, reconciling the accounts and preparing reports from them is referred to as what? It's referred to as posting. Why am I using this odd document? To increase an income, you debit it. Is it correct? No. Income,
No.
we credit, increase them. Which one of the following is what? The accounting equation. Resources in a business is equal to dash plus capital. So resources in a business are assets. Assets is equal to what? Dash plus capital. So assets.
Liabilities.
Assets is equal to liabilities plus capital. Correct. So resources in a business are also called what? Assets. So to record dividends paid, you must credit the dividend account. First, dividends paid, you need to debit them.
What are dividends?
Dividends are simply, who wants to try it before I answer?
Dividends, these are profits that are distributed among shareholders.
Excellent. So when you buy shares, the expected return on a share is called what? A dividend. A return on a share is called dividend. So shareholders receive dividends. The following accounting equation is a statement of the what? Of the balance sheet, which is financial position. So the accounting equation is fulfilled. So we have two types of balance sheets, the account form and the vertical form. Okay. Determining whether to debit or credit, increasing or decreasing an account depends on the monetary amount known on. It depends on the element, whether it's an asset or whether it is a liability. All right. To increase expense account, you credit it. No. Expenses, using PERLs to increase them, we do what? We debit them. The dash is used to record transactions before posting them to the accounts. So we use the general journal. So the journals, step 1, you start from journals. Step 2, you go to the ledger accounts. Step 3, you go to the trial balance and you post to our financial statement, which is the income statement. From the income statement, you go to the balance sheet. So number 1, the journal. Number 2, general ledger. Number 3, trial balance. Number 4, the statement of the comprehensive income statement, then the financial position. So, ladies and gentlemen, accounts is pregnant with principles. You don't know, you can't guess. That's why it's very important that we review these concepts over and over, so that as I go onwards to doing the statements, you're able to now reckon on what I have explained and been explaining. Any questions?
Mr. Collins, sir.
Yes, sir.
Yes, Mr. Collins, sir.
Yes, I can.
I think for me, I think I've not just gotten the concept on the PERLs. I think this is where I'm getting it wrong. I don't know where I'm having the problem in terms of getting the concept to know which one to debit, which one to credit on the PERLs. Maybe once I get to the concept, I don't know if you're able to go through the PERLs, how it works, and how do you know that this one should be debit and this one should be.
So PERLs is here. Debit is on the left side. Credit is on the right side. So this is support term PERLs. Now, PERLs are simply acronyms. So to increase purchases, we debit them. Meaning the opposite is to decrease purchases, we credit it.
Okay.
Expenses, if we want to increase them, we debit them. To reduce them, we credit them. Assets, if we're increasing assets, to increase them, we are going to do what? Debit them. To decrease assets, we credit. Then we go to this other side, revenues like capital. To increase capital, we do what? We credit. To increase liabilities, we credit. To increase sales, we credit. Now the questions will come in different ways. For instance, how do we increase rentals? To increase rentals, we debit. Is that true or false?
It's true.
It's
true
true.
because rent is an expense.
Yes, now you need to identify where the element it falls under. Correct. To increase capital, we debit. Is that true or false?
Capital.
To increase what?
Yes. To increase capital, we debit. Is that true or false?
Capital.
Not false.
Capital.
It's
What
true.
was the question again, sir?
But
Both,
does
you said?
capital also come in as an asset when
increase
starting the
capital,
business?
we
To increase
debit.
capital,
That's
we credit.
We credit.
why?
We
So
credit.
it's
Because it's a revenue. Capital falls under revenue.
Yeah.
Okay.
capital is 11, it's not an asset.
Yes, it's a revenue. So we credit. Okay.
So-
To decrease liabilities, we debit. Is that true?
False.
Yes.
To decrease
False.
liabilities, we debit. Is that true?
False.
It's true.
It's true. Yes, it's true.
Liability is on the credit.
Liability,
So the
Because
opposite
we
of credit
you
is
say
decreasing.
to reduce a liability, you credit,
No,
and then on the
no,
other
increase.
side it will be
No,
To increase revenue,
Increase a liability to credit.
Sorry, what's the question?
all this is to increase.
sir, just go through the question.
I
I'm
said
confused.
to increase a liability, according to what we are saying here, is by crediting. To increase sales, we credit. To increase liabilities, we credit. To increase
Yes.
sales, we debit. To increase expenses, we debit. To increase assets, we debit. Now my question is,
Oh,
to decrease a liability, we debit. Is this correct? To decrease
True.
liability, we debit. Is this correct?
Yes.
True. Yes, it is.
Yes, because it's the opposite of that. Now, sales. All right. Sales, to increase
Yes,
them,
sir.
what? We credit. Meaning the opposite of
credit.
sales,
Credit.
sales returns. So to increase sales returns, we do what? We debit. Purchases, to increase them, we debit. So the opposite of purchases is purchases and returns. So to increase purchases and returns, we do what? We credit. Okay. Debtors always have a debit balance. They're assets, in short. So to increase debtors, we debit. Creditors always have a credit balance. They are liabilities. They're just coming in a different form. So to increase creditors, we credit. I hope that is helpful enough.
Yes.
So,
Change.
yes.
So
Mr.
buildings,
Collins.
to increase buildings, we debit. True or false?
True.
True, because buildings are assets.
Asset.
Excellent. Yeah, what's your question now?
Yes. For example, I give you money, or I deposit money in your account,
Mhm,
and I make a payment.
mhm.
Now, under this payoffs, like on my part, I've given you the money. Does it mean that my account has been debited and then your account has been credited, or it's vice versa?
No, if you're giving me money, me, I'm receiving as a business. Okay, now that's
Yes.
the double entry principle. You debit the receiver, credit the giver. So me who's receiving, I'm increasing my assets. So the assets, which is cash, it's going to increase. So I'm going to debit my,
Your
you're
account.
yes, I'm going to debit my account, my cash account goes an asset.
Okay. Okay.
You're losing out money, all right? So you're paying out, all right?
Mhm.
So in my accounts,
Yes.
I'm going to increase my assets
Okay.
and reduce my liabilities because obviously, if you're paying me, you must have been a debtor. You must have Congolese. So to reduce my debtor's account, I'll credit you. I'm going to open a duality concept. So assets are increasing my cash. Debtors are reduce the value because in Congolese has reduced. So I'll put it on the left side. That's my next class. Okay, so don't preempt it. But those questions are for the next class.
Yeah, that is where, because for me, I thought if I give someone money, it means my account has been debited, meaning my account has been deducted, and then someone will receive the money, and then his account or account has been credited. That is where I've been getting.
Because you're looking at it from a banker's perspective. My account has been debited or credited. I'll explain all that. So now understand what happened.
That's where I also get confused. The
Yeah, I know.
debiting and crediting part, it just throws me overboard.
Yeah, the banking terminology is very deceiving. I have a lot of challenge with people regarding that. Yeah. So thank you so much.